Guys, I've been thinking a lot about this, but no matter what they tell you, cash is still trash. I don't care if you're getting 5%, it still sucks. Excuse my language.
Yeah, but it doesn't change in value, right? Come on, there's got to be some value. Some I can sleep well at night knowing that my portfolio is not going to change in value to the downside. I don't worry about upside. I only worry about downside.
Meanwhile, Bob, inflation's eating your lunch, right? And that's the problem. Like, I went back to last year, the money market fund paid 4.7% because during the course of the year, the Fed was raising interest rates. But inflation last year was 3.4% for the whole year. So you minus that out, then you pay taxes on that money market fund. You really made no money. Your money stood still for the whole year, even though you're earning interest, which is kind of crazy.
I made that same comment to a client of mine recently, and he said, Chris, why do you always got to rain on my parade with all this inflation talk?
Yeah. Well, here's the question, guys. Coming into the year, we were supposed to have 6, maybe 7 cuts by the Federal Reserve. Why do we trust anything coming out of the Federal Reserve? And really, why does it matter, right? The Dow's at an all-time record high, values at an all-time record high. There haven't been any rate cuts yet. And here it is, coming into September.
Well, so basically what you said, Bob, is the Fed has done nothing and the economy is doing really well, which says to me, maybe the Fed doesn't really matter. You know what I mean? Maybe they get way more credit. Maybe every week when Jay Powell comes out and he's ready to speak to the masses, and he basically says nothing, by the way. He's very measured in his speaking, talks very softly. But really, maybe the Fed, if they raise rates, they cut rates here, they keep rates the same, doesn't have this major impact on the economy that everybody wants you to believe.
Well, it appears that way, but I guess here's my question. Jay Powell came across very dovish. I mean, more dovish than he's been in the last 2 years. Now, there's an election coming up. So my question is, how do you think he's invested? You think he's set? I mean, is he in good shape financially? Because whichever way that goes, I can argue either he wants the job, he needs the job, or he wants to go out on a high note like, hey, I saved the economy. I don't know. What do you guys think?
I always tell clients not to invest based on their ego. Maybe Jay Powell should take the same advice.
Well, I think what you're alluding to, Bob, is, is the Fed acting independently? And, one would argue, why would they cut rates at all if, let's face it, employment is still low, right? And maybe it's ticked up a little bit. Job growth has been pretty spot on. Inflation's coming down. Why would you screw that up with a rate cut? The only reason I can think is because there's just too much pressure on Capitol Hill to do nothing, which again speaks to there's probably a lot of influence outside of being independent that's driving the Fed. Just my opinion.
Well, here's my thought. I mean, does he need the job? I mean, why does he want to listen to the Hill? If he's finished at the end of this term and he doesn't want the job, why does he care what the politicos are saying?
Oh, he wants that job. I totally agree with that. He definitely wants that job. But, I think that also speaks to going back to cash right now, right? If the Fed is going to cut interest rates, and we're almost 100% sure at this point, September, and right now that 5%, you've only earned 3.25% so far this year, by the way, because it takes all year to earn the whole 5, is going to start to go down. Then what are you going to do with your money? Why would you sit in cash here? Why would you stay short term? Yet I talked to a lot of investors. They still want their money short. That kind of blows my mind.
Yeah, but when they start seeing, they get those tax returns or they start getting their statements every month from the bank and seeing they're getting less interest, I think those money markets are going to look a lot less attractive and the market's going to start looking more attractive.
But why wait? That's my question.
Well, really, isn't that the $6.2 trillion question? What is going to happen to that money? Is it going to go into the stock market? Are we going to have a melt up? Are we going to have an inflationary event because all this money is going to go out and start buying real estate and invest in stocks and push the bond market down? So I think there is, some risk. I think that the Fed fears of causing some kind of a melt up in the market.
Yeah, and if that happens, the economy does heat up again. Does the Fed raise rates again?
Yeah, because you have inflation, right? And so do they want to be the cause of inflation after they're taking their victory lap?
Well, and I think actually that's probably the bigger risk that no one's talking about is maybe they're cutting too early, right? And it seems to me, the Fed, again, maybe a political position, that they probably may cut more than once this year and a couple more times next year, which in effect, Bob, could cause a real bubble in places like the stock market, the real estate market, because if rates go down, That's probably going to get the real estate market going again. We're going to start to see more sales and purchases of real estate. Do we inadvertently cause a bubble, which will probably cause inflation, and the Fed's going to look very foolish retrospectively? I actually think that's very possible here.
I don't know. It all comes down to whether or not Jerome Powell is in good position financially. Does he need the job or not? That's the question, guys.
I suspect it probably has something more to do with power than financial need, but who knows? But if rates do go down, I wonder if Ryan may finally invest in real estate.
No, but I think that's the real question here. But I think as an investor right now, what you need to be thinking about is you can't sit in cash, right? We've talked about that. It's like you see the steamroller. It's still a good mile away, but it's coming. Don't put your head in the sand right now. It's a good time to lock into some yields longer term. Don't get seduced by keeping it short term because that rate's going to go away quickly. And secondly, you have a big risk in the stock market of a melt up here at some point. So don't wait for this pullback in the stock market. People text me, email me all the time. We've got to get a sell off here somewhere. We actually don't. So don't risk it.
Well, that's the beauty of being a long-term investor. It's the beauty of having this podcast, right? We're intuitive. We know that over time, the markets go higher. We know that, inflation is moderating. We know interest rates are falling. We know the Fed's going to cut eventually. And that's why you have to ignore the noise, the short-term noise. All that does is make you a bad investor, right? So it's, if you look at the opportunity is there every single day. It's obvious. I mean, if you think longer than 15 minutes, everybody can be a successful investor.
Well, Chris only cares about his yield to lunch, so he might not be the yield to noon, as we say. But for the rest of us, no, it's a great point. And also, I think investors feel like they're between a rock and a hard place, right? It's like, well, I've been sitting in cash. If I put my money in now at the all-time highs, that's going to be the day the market actually goes down. But the reality of it is, if you diversify your money, we use that term a lot, like you own other asset classes, right? They don't trade that expensively right now. We saw real estate stocks are starting to move again because rates are coming down. Financial stocks, if you look at utilities, have had a great run. They all pay dividends. They traded a much more reasonable valuation cheaply. So there's a tremendous opportunity to invest your money right now. You just don't want to consolidate into everything that's been the hottest, aka NVIDIA, the S&P 500. It's a great time to diversify your money.
If I hear what you're saying, Rye, you should also buy AMD as well as NVIDIA.
You weren't listening at all, Chris. But
well, I love it. Back when we had our back a year ago, we had a little panic in the market. I mean, actually was in October. It'll be October a year ago. We had a whole 10% correction, and it was amazing how many people we had to walk off the ledge because they wanted to go to cash to get that 5% because my goodness gracious, stocks are risky. And they would rather buy, put money in a 5% or 4.8% money market fund than make an investment in real estate investment trusts, which were yielding 4.5% and have appreciated 10% since then. So, hey, guys, give me 4.0 to over 15% anytime, right?
Yeah, well, there you go, right? Dividend yields are going up. Cash flow is rich in the stock market, and you can lock into bonds here. Whereas if you sit in cash or short-term bonds, your yield is going to start going down. Simple math here, gang. Be proactive, not reactive. You heard it here first. Hey, hope you're enjoying the most recent episode of Payne Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million, Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life, and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products. Whether it's an annuity, mutual fund, brokerage product, we'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to payneCM.com/financial plan or click the link below to see if you qualify for a free financial review. All right, it's the tipping point. This is where we pinpoint the pain point. That's PAYNE, having the biggest impact on your wealth right now. And guys, I've seen lots of headlines lately talking about, is the 60/40 portfolio dead? And of course, 60/40 means 60% in stocks, 40% bonds, which is supposed to be this like tried and true allocation. If you have it, it should be the recipe for success and financial independence over the rest of your life. So what do you think? Should I just put my money blindly in a 60/40 allocation, or is it dead now?
Right, I'm really glad you clarified that 60/40 is an allocation and not the amount that you work. But yeah, I mean, I think the 60/40 is like the 4% rule. It's a rule of thumb. And, what is a 60/40 portfolio anyway? What does it consist of?
I don't know, Chris. That's why I pay you the big bucks so I can go on vacation and enjoy my 60/40 lifestyle. 60% rest, 40% guiding you. One would say is enough. But no, that's a great point, right? So 60% in stocks, what stocks? 40% in bonds, what bonds? And why 60% stocks, 40% bonds?
I'll tell you what, that whole rule of thumb, the 60/40 portfolio doesn't work anymore, coupled with the 4% withdrawal rate. That's great clickbait. But is there a reason why they always choose the S&P 500 in these articles over the last 15 years, guys?
Because it's done the best.
Exactly.
The last 15 years. But we forget, right? From 2000 to 2010, you made no money owning the S&P 500. And that drives me crazy. Think about that. If you retired in the year 2000, you put all your money in the S&P 500, by the end of that decade, you would have made no money and you've been drawing from your portfolio. And I think most of us, when we're building our portfolio right now, don't realize that because it's been such a good run. And what scares me is a lot of you right now, you're invested with a lot of your money just in the S&P 500. And great right now, but might not be so great in the future.
Well, wait a minute, Ryan. The S&P 500 has 500 stocks. That's really well diversified, right?
Well, it is if you only own one, I guess. It's if you're just talking math here, Chris, I think you're absolutely right. But I don't think it's just the investor's fault. How many portfolios have we reviewed recently, proposed portfolios, where I know every advisor shows these investors the quilt chart, right? The difference of performance of different asset classes year over year, but they come in 100% invested in the S&P. So who's at fault here? Is it the investor or is it the purveyor of investment products?
Yeah, I agree. I mean, I did a proposal for a prospective client recently, and this person was in a 40% tax bracket. And he had treasury bonds in his 60/40 portfolio. I mean, a very simple solution to that would be to use something like a municipal bond where that income is tax-free. That's a big savings.
It is a big savings, guys. And it's, let's face it, building an asset allocation is both an art and a science, right? The science is easy. Anybody can look at past performance. Anybody can look at the 100-year performance of different asset classes. But there's an art to how to build a portfolio. And what it really matters is the buy-in from the investor. If the investor buys into the strategy, they'll stay invested, right? And hey, we're at 41,000 on the Dow. What happened when we hit 18,000 4 years ago? Did everybody have the courage to stay invested in their strategy?
A lot of times the panic button was getting pressed. We know. But no, I think it's a really good point. And I think the problem is investing is all about nuance, right? The devil is in the details, yet when you hear advice, blanketed advice for the media, you tend to get these like broad rule of thumbs that you can utilize, and it just doesn't work in practicality. Like to your point, Chris, if you're in a high tax bracket right now, what type of bonds do you want to own for your, let's say, 40%? Is it taxable bonds, tax-free bonds, right? So they're all questions you have to ask yourself. And if you have money in equities and you need to draw from your portfolio in retirement, would it make sense not to have everything in the S&P 500? Because the S&P 500 is very concentrated, great when it's going up, but what if it goes down like it did 2 decades ago when you retire? These are the variables you really have to consider when you're building that financial independence plan.
Well, Ryan, I think on that point, I think a better name for this article would be, is your 60/40 portfolio dead? Do you own the right things? Are you diversified? Are you owning the proper bonds based on where you are from a tax standpoint? And will it help you succeed for your long-term financial plan?
Well, that brings up another really good point is, should you even have 60% in stocks, right? Because as you get close to retirement, or if you're retired right now, a 60-40 portfolio still can go down a lot in a bear market. In fact, back in 2008, that portfolio would have been down like 25%. So, you really have to determine, should you be 60-40, 50-50, I don't know, 30-70 based on what your goals are, not based on, again, a blanketed rule of thumb. That's another major mistake I see most investors making.
Guys, I think the whole key here is it takes a lot of time and effort. And, you know, if I'm a client, why would I want to spend all my time and effort doing what we do? So it's really important to understand, how different things are performing at the time. And you have that sequence of return risk, right? So if all your eggs are in one basket and when you need that money to live on, you're selling low as opposed to being able to, take the yield from your portfolio or take what's up out of your portfolio. It's kind of like, when you have a garden, right? You're able to reap what's ripe as opposed to pulling the new plants up by the roots.
So, about what you're really saying is diversification is just having a garden with lots of different plants in it. Simple.
Well, only a garden that works when it's well tended to, right? This is not something you can just make it up and then forget about it, right? It's something where you have to monitor it every single day.
Bob, the Farmer Wealth Advisor. I love it. Sign me up.
It's an agrarian science. You guys never knew that, did you?
All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, individual investors have become massive risk takers. At the beginning of the bull market in 2009, individual investors' equity allocation was only 39%, and their beta was a very conservative 0.75, meaning they were relatively conservative. The allocation today is 63% equity, and the beta, a measure of risk, is all the way up to 1.25. Man, oh man, it just needs a bull market to get those animal spirits out.
Rye, it just goes to prove that it's all human nature, right? We all project the future based on our most recent experience. The higher the market goes, the more brave we become as investors. And I remember how frightened everybody was in 2008, 2009, after the great financial crisis. I mean, valuations were a generational low. I mean, it was a buying opportunity of a lifetime. We started Payne Capital Management then, and we told everybody that, and they thought we were crazy. Turned out we were pretty insightful.
It's actually pretty funny, though, because someone said to me the other day, man, this has been the best time to be a wealth advisor like yourself. Markets have gone up for like the last decade. And I laugh because to your point, you couldn't get anyone invested the last 10 years because after the great financial crisis, people were so panicked. They'd rather sit in a money market fund, which was continuing to go down because interest rates kept getting cut, than put their money in the stock market, which is remarkable. Now that we've had this magnificent bull run, all of a sudden the masses are getting invested now. This is why most investors usually don't make a lot of money.
Well, I just did a portfolio review with one of our largest clients, and they said, yeah, it's really great, Bob, but like, let's, truth be told, how hard was it, to make money in the last 15 years? I said, well, it would have been really difficult for you because when you started with me back in 2008, you were 100% in cash. I said, had you gotten it invested, you'd have a zero return.
It's always easy in hindsight. It's one thing we've learned in this business. Chris, Walmart is using large language models to create or improve more than 850 million pieces of data across its product catalog, a process that would have required 100 times the head count to complete in the same amount of time, according to executives. That's AI creating massive productivity for a very old school business, retail.
Hey, Dad, I think we should start using large language models to replace Ryan. Imagine how much money we could save.
I'm happy to retire on a beach. Just send me a check. Well, that's it for this episode of Payne Points of Wealth, episode 171. If you like our podcast, love our podcast, please give us a 5-star rating. If this is on iTunes, leave a comment. If this is on YouTube, you can like this episode. You can subscribe to our channel. Click that notification bell to be updated every week of all our new content. If this is Spotify, you can subscribe. Give us a 5-star rating. Your support gives us the ability to continue to do this podcast. That's it for this week. Stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully, you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.